Santoli, thankfully, back from a break here at Post 9 with more on what he's watching. And this notion that maybe 5,100 is a firmer floor than we thought a couple days ago.
Yeah, it obviously has a plausible basis of being a little bit of a floor. I mean, I don't think there's any magic to it. I do think what does happen is when you get a bit of a disorderly sell-off like there was yesterday, and frankly, you know, looking at it from a little bit of a distance, it didn't seem to me to be that logical that it would be strictly in response. I know you guys were talking about this, to the, the aggressive
stuff.
language about Powell. It's like a lot of it was maybe China kind of hawkish tone and things like that. But more to the point, the big picture is the trends are lower, right? It may not be ultimately a durable bear market, but you have to almost operate on the premise that rallies are suspect and this market has to earn back the benefit of the doubt. How does it do that? Well, when you're at 5150, which is where we closed yesterday in the S&P 500, you're less than 4% to the lows of a couple of weeks ago. The absolute lows for this move, that's 4850. The upside to the top end of the range, which is just the low from April 2nd, is 8%. So you have twice the upside versus the downside if you're just trading the range. And I think that kind of thing, once you have very washed out positioning, I've been saying that for weeks, it's now even more the case, that institutional positioning has gotten very cautious. Defensive leadership is the only thing you find within the stock market. You look at the low volatility ETF relative to the market, it's been a place to hide. Everything else is nothing but gold. So all that together with the understanding that even though the trends might be lower, we stopped exactly short of a 20% decline on a closing basis. There's a long history, I talk about this all the time when it gets relevant, of 19% peak to trough declines in the S&P 500, way more than you would expect just by random chance, okay? That was 2011, that was 2018, it was 2015-16, I believe. It was 1990. You have all these instances where somewhere there's a bid at the down 20% level. Bundle all that together with the understanding there's upside risk if you get any kind of a trade deal. I think that explains today. It explains the chop. I don't think it settles anything. It doesn't settle the whole sell the U.S., buy gold type of trade, which maybe is starting to seem crowded and obvious. That doesn't mean it's over.
Right. I mean, I mentioned earlier, again, having nothing other than long conversations with people that I've been talking to for so many years. Negativity, man. Everybody is negative. Don't know what that means. You seem to be explaining it might mean we get a bit of a rally.
I think it does mean that, at least on a narrow time window. Yes, it usually does mean that. And that's why bear market rallies are so ferocious. You have a lot of pent-up short covering that can happen. And people who just are going to feel underinvested if the market seems like it found its footing. And, you know, so much of the downside yesterday was also, again, in the big NASDAQ 100 stocks. You know, Meta just getting thrown overboard. And all of these names, and it's like, well, that's not really finely geared to Fed policy. That's not really about, you know, something that's about interest rates. It's kind of just, the world owns a lot of these stocks. They need to own less of them at the moment.
Mike, stay close.